Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Yesterday, we had some follow through on the green shoots of stabilization as posted Friday morning, just in time for St. Patty's Day. That was literally market thoughts / trading room review. So we got the green shoots. Hans was bullish last Wednesday. We got some stabilization Thursday, and then absolute dealer covering and chasing on Friday, followed with Monday advance. And today we pause, especially after VVIX dropped all the way down to the 92 handle. This is what I noticed on Friday morning. It was definitely dropping more than VIX, and VIX is also just below the 21 handle. So from that Friday morning that we would get some relief here into VIX expiration, which is in fact this morning. And this was the backwardation that we had starting to reverse, which is also very bullish. And we got a whole bunch of central bank decisions coming up, not expecting any surprises, but this is kind of why we're taking a pause, I think, today, since we just had 2 very strong days of relief bounce. And yet we did not have any relief bounce in Brett, which is fascinating to me. So they definitely came in and bought for 2 days. I'll show you that Friday and Monday, but Brett did not get anything more than stabilization. I'll show you that as well. So right now, I think we have a kind of calm before FOMC, Bank of Japan, Bank of England. Of all the central banks this week, only Swiss National Bank is expected to cut. I already wrote up a review of the retail sales, etc. And yesterday we had no lack of drama in the evening as it related to war escalation in the Middle East. So as Trump is trying to force an armistice between Russia and Ukraine, he is definitely escalating with Israel against Iran, Hamas, you name it, in that neck of the woods. So there is no relief there. Jobless claims, like I said, it's been very much a deportation story for blue collar and government layoffs from Doge and such for white collar, and then all the peripheral plus pickup in bankruptcies and such. So we definitely have jobless claims to track every single week for some shake and bake in the market. But otherwise, we don't have so much news in economic data this week. So that was just a little review yesterday, since we did have retail sales, but we still had interesting, if you remember yesterday morning, I'm like, wow, retail disappointed, maybe not the core, but definitely month over month. And yet retail stocks were popping up like daisies. And part of that's hedge fund factor rotation, short covering. It really was obvious that so much junk was coming up off the bottom. That is not a good place to lead, but it did help the stats, right, show a big kind of advanced decline for small caps, because it was a lot of crap that was coming up off the bottom. Just saying. Mag 7 was not part of the party, Tesla, Nvidia, and the rest. And then this morning, we still have more weakness in that concentration risk. So high beta is still underperforming low beta, long story short. We got some lowered estimates for 2025 US GDP, and that's actually very much part and parcel for what's going on right now, meaning in 2023, GDP forecast was extremely small, and because of government stimulus, we beat it. And then 2024 GDP was a little bit better, but still they underestimated it because, again, still lots of government stimulus. 2025, they are overestimating it big time. So it's getting re-rated across the board by everybody, Atlanta, Goldman, JP Morgan, you name it. Because they realize, oh, we're not going to get stimulus. Oh, all right. Well, that was a big component. We had a big component of government spending for jobs and programs, and it's gone. And that's the point. It's now being lowered. So that means the stocks have to be lowered, re-rated. Whether or not recession comes into play, that's another matter. But for right now, the risk is being pulled forward as GDP estimates are revised lower, full stop. You can take a look. But I wanted to capture that because that's what I see. So the week ahead, as I mentioned, mostly jobless claims on economic data and Fed. I will have the room open from 2 to 3 for the FOMC and Powell presser. And then at 4 o'clock, Hans and I will do our macro to micro options power hour and kind of review all that good jazz. Fund flows and seasonality. A lot of folks are getting really excited about this 2 days of green on the screen Friday, Monday. And they're saying, hey, we've already had our pullback. S&P fell 10%, NASDAQ fell 15% since February 19th, which is lucky or good, exactly when I warned. And I want to show you that very, very, very key. I had 5 reasons. Keep it below 6,100 in SPX and keep it below 539 in Qs. But there was one particular chart that has really, really helped. And I want to show that to you because this is part of what bounced strongly. So yesterday, what happened? This is literally that diamond shape on the intraday with this ratio, and warned on Tuesday, it was setting up bearish. And then it did, of course, follow through, little itty bitty bounce and follow through, itty bitty little bounce and follow through, and then really crashed. And then we're right back up to the January 13th level. So this is what we had yesterday. That's it. So we had basically green shoots, not Thursday, but Friday. And then this is Monday. Now I have a 2-hour. You can kind of see how it works from the inside out. And this is the daily. And this is a fractal overlaid with inverse VIX as well as the Qs and SPX. So you can see that when this rises, so does this stuff. But big picture, we're still in this kind of ugly, drawdown. Again, 10% for SPY and 15% for NASDAQ. But we still don't have a real impetus yet for moving higher. If the Fed comes out tomorrow and says, yes, we will pause QT, you will see an impetus for higher. You will. They're not going to cut the rates tomorrow. That's not the expectation, but they will potentially say, hey, we're fine. And the market's going to say, really? Or it's going to get excited like it did with Powell that day he came out and did his Friday morning event, and we bounced for 1 day and then dumped right after because he said the economy was fine. Okay, so the point is we don't know what tomorrow's going to bring, but I'm just saying if there's any language around QT being paused, you know what to do. It's bullish. In the meantime, last but not least, we do have seasonality, as I mentioned, but, color me skeptical. This is typical that in this March options expiration week, it stays bullish, it stays bid. It happens to be an FOMC week, etc. But the point is it usually stays bullish for the week. And then we can go back into a bearish mode after options expiration. We might even get it pull back sooner, retest that 5,500 area that I wrote about yesterday into Friday. But for right now, let's see what I get for my intermarket, which right now I want to show you, believe it or not, despite the 2 days, is not that impressive. So this is highly suspect. And I say that because even though we have this seasonality and we have end of month JP Morgan expectation of rebalancing, right? Mutual funds, which can be up to 135 billion. That's money coming in. Are they rebalancing into bonds, stocks? So that distribution matters. But the bigger question, is this 2025 more like 2022, where oversold stayed oversold until we got a policy intervention? Remember September, October 2022? Big, huge policy intervention. But during 2022, folks just kept dumping equities. They were not hedging. We did not get volatility spikes like that August Jen Kerry trade. We did not. Folks were just dumping, period, full stop. NVIDIA fell 65% in 2022. That kind of stuff. They weren't hedging. They were just dumping. And that's what I feel more the market is for 2025. But some are very much expecting more of a 2023, 24, right? When NASDAQ doubled. And that was because we had these violent bounces in convexity short covering rallies on VIX hedges. They were being unwound. There were expectations of policy intervention. Right now you hear folks talking about QE, which I don't think is a thing, all in the effort to tap down dollar and yields, which were a headwind to equities. And at the same time, I have the complete reverse view right now that the falling dollar is money going home and rising yields would help actually equities go higher short term, just in this kind of Goldilocks zone, because we're in a deflationary impulse as yields are falling, and that pulls forward recession risk and that makes equities sell off even more. Back then, or the past few years, we've had this economic expansion from fiscal stimulus. And yes, we also had strong consumer and business activity that supported the bullish flows. We had mostly GDP expectations that were underestimated and then they were beat. Now we have overestimated GDP and it's getting re-rated lower. So in a nutshell, it's a different market. But because I think the policy agenda is very clear, and I talk about that on Friday afternoon, where I think this market sell-off is is a feature, not a bug. And literally, Basent is out there again this weekend. Sunday, where it seems pretty obvious that the policy agenda is to weaken demand, not just corporate and consumer confidence, but demand and growth. So to tap down inflation, at the same time, they're not trimming the deficit. At the same time, they're just moving the war funding from Ukraine over to Israel to fight Iran, etc., and company. Anyway, the point is, he came out this weekend and he said corrections are healthy. They're normal. What's not healthy is straight up that you get these euphoric markets. That's how you get a financial crisis. So Treasury Besant is still talking down the buyers, and I think we should listen. There are no guarantees. A recession would be avoided during the economic detox period. I don't know. I'm going to listen to the guy. I think that makes good sense. Just kind of pay attention to the fact that policy agenda is very, very negative risk assets. So that's all there is to say about that. Anyway, and it's also very much part of their policy, and I've talked about this even before Trump, with the expectation that if Trump came in, they would work on lowering the demand for US dollars. It's too overvalued. They want it to fall. It is by design. I have been very focused on that for months. So it's working, it's falling, money's going home, the inflation assets of equities are falling. They're trying to deflate some inflation risks, but like I said, as long as the deficit is rising, spending is lowering, and CFOs are worried, all that stuff, demand falls. But for right now, the next kind of shoe to drop is oil. It has not, but that would be the next one where I think any pop is to be sold because we have falling global oil demand. And China is really bent on pushing forward its EVs, not just for its own consumption, but abroad. So this is a matter of time before we kind of push into that falling oil demand narrative. And I think it will be at some point this year, and it will probably fall on a combination of recession risk pulled forward and falling global oil demand. I know outside of recessions, every time you get a 10% SPY dip, it's been a really good time to get equity longs. I don't think that that's a great setup right now. So my baseline bet is that recession calls are growing louder. It doesn't mean that we're going to be in one, but it pulls down risk, full stop.
Join Club today to engage with Samantha and her team of 10 experts. Scan this QR code or click the link in the description. Subscribe to LaDuc Trading YouTube channel for more live trading room recap videos and other content.